So welcome everybody, and I hope people will connect during my introduction, so they will not, they will be able to listen to the results of the study. So welcome to all the participants and panelists. I am Pauline Becquey, I'm Managing Director of Finance for Tomorrow, and I am very happy to welcome you on this webinar to present the results of a study conducted by I4CE on the potential effects of a green and of a brown penalizing factor. This proposal is crucial. The objective is clearly to overcome the classic opposition between the supporters of a green supporting factors, meaning a prudential relief due to the lower risk of green assets, and of a penalizing factor, meaning penalizing activities that emit high CO2 levels because they are more exposed to transition risks. The issue of this study is to determine whether this instrument would be an appropriate way to increase the contribution of banks to financing the transition. As the main financer of the French and European economies, banks play a key role in financing the transition. Their current contribution in France is in order of 8 billion euros per year, but this will need to more than double according to estimates made by I4CE. To accelerate this shift for banking institutions and to prevent their increasing exposures to climate risks, the debate has tended to revolve around whether or not there is a need to reform prudential requirements. The purpose of this requirement is to safeguard financial stability and to protect banks in crisis situations by obliging them to hold reserves against different risks. There are two conflicting positions on climate issues between those in favor of a green supporting factor and those who advocate a penalizing factor. When some argue that green assets are less risky, we should justify a prudential relief measure. Others stress that the risk differential between green assets and normal assets has not been demonstrated, but that harmful assets, fossil fuel, aeronautics, combustion vehicles, etc., are more exposed to transition risk. The debate is clearly not closed. In its renewed sustainable finance strategy announced last July, the European Commission indicated it will propose amendments to the prudential framework for banks to ensure ESG factors are consistently included in the risk management systems and supervision. To achieve this, clear requirements will be set to identify, measure, manage, and monitor sustainability risks in the risk management frameworks, including climate change stress testing for banks. To complement this, and as part of the annual supervisory assessment, the role of supervisor in assessing such risks will be clarified and strengthened. Finally, the Commission will propose for the European Banking Authority to bring forward its ongoing assessment of the prudential treatment of exposures related to assets or activities associated substantially with environmental and/or social objectives by 2 years to 2023. I thank very much the co-author of this study, Julie Evain and Benjamin Chamberlain, who analyzed the impacts of these two approaches on project financing, on the internal profitability of banks, and on credit growth or contraction. Julie Evain will present you the main results and conclusions of this study. In a second part, Pierre Monnin, Senior Fellow at the Council of Economic Policies, who was part of the external review committee of the study, will present its feedback on the research, but also the various tools that supervisors can use to increase the contribution of banks to finance the transition. We would like to have around 30 minutes dedicated to your questions after the presentation. So please do not hesitate to use the chat during the presentation of our panelists to share your feedback and questions, and I will ask them the question afterwards. So please, Julie, the floor is yours.
Thank you, Pauline, for this introduction. I'll just share my slides. I hope it's working. Okay, great. So just a quick word on the background of the study, but Pauline already introduced you to it. So as we said, the debate was mainly focused, the debate regarding capital requirement was mainly focused on a risk-based approach with this idea, or is there a differential between a green and brown activity? And our study does not position as a response to this debate, but we rather, what we tried was to simulate the different application of supporting factors and of penalizing factors. And then we looked at the impact that it would have first on transition financing for green projects and for carbon intensive activity. Then we also look at what happened inside the bank for its profitability. And then we looked at the growth effect or contraction effect of all credits, not just the green or the harmful activities credits. So that's what we did and what we haven't done. So regarding the results, I will first describe the results for the supporting factor modelization, and then I will talk about the penalizing factor ones. What we did was we choose 3 different values. So of course we stick with the classic one, which is the 25% reduction, which already exists for SMEs, for instance, or for infrastructure. But we also tried with a low supporting factor and with a stronger one. And we took 2 main hypotheses. The first one is that the supporting factor only applied to inflows. And we also take the what we call the very favorable assumption that the bank transfer the entire cost reduction in terms of decrease of the credit rate. So it does not keep for itself the cost reduction. So that was, we took this hypothesis in order to get the maximum impact on transition financing. So I will give you the results of what we did for 3 sectors: for mobility, for energy retrofitting, and finally for the renewables. So what we saw is that the impact for those 2 first sectors is very, very low. And what I mean in terms of very low is that, for example, for buying an electric car, the gain that you have is only 200 euros if your car is 3,000 euros. So you can see that compared with public subsidies, or even with the cost reduction of electric car, this impact is very, very low. Then we also did this model for energy retrofitting, and here the gain is also low. As you can see, for a project of deep renovation, that would be 80,000 euros. The gain that you have is only 600. So you see that it's not the impact of a supporting factor is not strong enough to really stimulate the new project. And here what we took is very favorable assumptions, because the impact that you get is with the strong supporting factor, so not with the classic one. And finally, what we have with the renewable energy sector, here it's a bit more interesting because the maturity is longer, so the impact is a bit more important. But what our recommendation regarding renewable energy is that there is already the infrastructure supporting factor that exists. So we suggest that instead of having 2 supporting factors, it would be better to just limit the infrastructure supporting factor to green infrastructure. So that's for
Julie, sorry, it seems that there is a problem with the slides that are cut on the left. I don't know if you can try to maybe share again.
Okay, yeah, sorry about that. When we tried before, it was working.
No, when you go in full screen, we cannot see.
Okay. Maybe what I can do is enlarging. If I do it again, no, it's still.
No, it's still cut on the left.
Okay.
So sorry about that, because we tried.
No,
we tried
before and it was working. Maybe I can, if I keep that way, is it better? Can you see everything?
Yeah, yes, I guess
it's not in full slide, but okay.
But at least a participant can see the full text.
Okay, we can send the slide afterwards also so that
Okay.
it's better.
Okay, sorry, please go ahead.
Yeah, thank you for interrupting me. And now I don't know how to move the slides. Okay, yeah, so that was the slide for renewable. And then, so moving on the, can you see it entirely or? Yeah, okay. So coming on to about the effect on credit growth and on bank profitability, which is also some parameters that we tried. What we saw is that the expected effect on credit growth is quite uncertain and hard to assess because it depends on what the bank is doing. It depends on its strategy. But what the figures we came up with is that the credit growth would be quite low for both green and generalist credits. And in terms of profitability, the supporting factor would of course be profitable for banks, but not that profitable. We came with the figure of between 0.1 and 0.4 billion per year for the entire French banking sector. And finally, what was a bit more surprising for us is that we thought at least a supporting factor could encourage the bank to adopt a proactive climate strategy. But we saw that actually and I will show it to you in the next slide, the difference that you see between a proactive and a wait-and-see attitude for banks is appearing only on a medium term and not in the short term. So if you're looking for short-term impact, it's not, the supporting factor is not a good tool, because you really start seeing a difference between proactive banks and wait-and-see banks in 2005. So moving on to the results on the penalizing factor. Here, what we've done is for the supporting factor, we took the green taxonomy and some estimation that already exists. But for the penalizing factor, it was harder to do some models because, of course, the penalizing factor can apply to various scope of activities. So what we did is we tried with a very strong penalizing factor, but on a very localized scope, which would apply, which would be similar to coal. Then we did a moderate penalizing factor with a scope that is a bit more wide and that applied to fossil fuels, to a perimeter that is similar to fossil fuels, because of course it's very hard to find some right estimation for what is the perimeter of fossil fuel in bank portfolios. And finally, we did a third type of model with that would be a low penalizing factor, but with a kind of with a perimeter that would be similar to harmful activities taxonomy. So that's the three models that we did. And here we took the hypothesis that the penalizing factor would apply to both stock and to inflows. Whereas in the first model, the supporting factor would apply only to inflows. So that's a bit of a difference also, and we can discuss after why we do this choice. So coming on to last elements that I want to tell you about the models that we did is here we designed 5 types of exit scenarios for banks. So of course, not all the scenarios are possible. For example, if you choose that penalizing factor that apply only to coal, it's easier for banks to exit quickly from those type of sectors. But if it's a penalizing factor that apply to all the harmful activities, of course, the banks can exit only slowly, with a much slower pace. So that's why we designed those 5 scenarios. And what we saw is that it's a bit similar that for the supporting factor, in order to have an impact on the project, you really have to go for a strong penalization. Otherwise, the increase of the cost is not strong enough to get an impact on whether or not the project will happen. So that's why we saw that that we need a stronger penalizing factor to get an increase in the project cost. For us, a strong, of course, we can debate on what is a strong penalizing factor, but we saw that if you go for an increase that is to 250, sorry, you can already increase the cost of the project by 10%, especially if it's project with long maturity. So that gives you an idea of what can increase the cost of the project already. And what we see, and I will show it in the slide, in the next slide, is that when you put in a penalizing factor, you see already the impact that is happening very quickly in the first year, and you see this contraction in the balance sheet. So what we see is that applying a strong penalizing factor, it gives a strong incentive for banks, of course, because the penalizing factor is very high. And also, as the perimeter is quite reduced, it's easier for bank to exit quickly, and then the effect on the contraction effect on the credit is quite reduced and limited in time. After a few years, it depends, of course, on the strategy of the bank, but after a few years, it can this contraction effect can be finished. Here it's the result for penalizing factor that are for fossil fuels and for carbon intensive activities. And here what you can see is that the incentive is more diffused, and so it's harder for banks to exit quickly. So what we saw with those modelization is that the credit contraction, the credit crunch, lasts much more in time, and it can be a bit it can also affect the green credits, of course, because the banks don't have enough reserve as they used to have, and they have to reduce the amount of credit that they were doing. And this effect lasts much more in time because it's harder for banks to exit from those activity. And finally, a last point regarding this penalizing factor. There's two types of metallization, so moderate penalizing factor on a fossil fuel parameter and a low penalizing factor on a harmful activity taxonomy. Is that we think it can be a bit counterproductive regarding what it aims to do. Because it's especially for the last one, which is for the harmful activities, it doesn't take into account the dynamics of transformation, whether or not those enterprises are in transition or not. And it can also block their access to credit, especially for some industries such as automobile, aeronautics, or cements. For fossil fuel, it's a bit different because they have this organization with subsidiaries. So subsidiaries that are into renewables can still have access to credit, but for the others, it can have some counter-effective effects. So I'm just gonna give a quick word on our main recommendations. So as we saw, even if, sorry, again, the slide were cut, the impact of a supporting factor is not strong enough to really stimulate the new green projects, even with a strong supporting factor. And what we saw is that to get a real impact on how to increase the cost of the project, you have to go for a strong penalizing factor. Otherwise, the incentive is too weak. But for that, you have to limit it to energies for which you already have a clear exit plan, such as coal or such as new explorations. But however, what we also say is that the penalizing factor should be handled with care and limited to and restricted to a limited scope, because you can have some credit crunch effect, or you can also penalize some companies that are in transition, which and have an impact, a negative impact on green credits, which is not what you are targeted with a penalizing factor. So in our last word is also that it would be, for us, we think that it would be also interesting to start exploring some Pillar 2 instruments and not just Pillar 1, such as capital requirements. And in Pillar 2, we can exploring the net zero commitment that many banks are taking, and also transition plan for banks, and see how it can be more substantial. So that was it for my presentation. Sorry again for this slide issue. Pierre, I hope you will be better than me on this.
Thank you very much, Julie. So let me directly check if I got things right with the slides. Can you see everything? Well,
yes.
So thanks for giving me the opportunity to comment on your study, and congratulations for it. As Pauline rightly pointed out in her introduction, using capital requirement to support the energy transition is a heated debate. The question is whether to use it and how to use it, with a penalizing factor or a green factor. In such a debate, I think it's very important to have good studies that analyze all the effects. And this was clearly lacking. And with this study, you feel a gap that is useful for everyone. Another very good point of your study is that you also look at side effects of a green penalizing factor or a green supporting factor or brown penalizing factor. The side effect on a possible credit crunch that, for example, a brown penalizing factor could trigger. This is new, and this is very important, and I think it's bringing a new light on this tool. Now, for my remarks, I would like to focus on three things. First, another side effect on financial stability, and then more going up a bit deeper on your recommendation, and finally, just look at what could be alternatives. So, as Pauline really rightly underlined in her introduction, capital requirement first goal is to strengthen financial stability. So that's why there are four, and the idea is that there are risks when you give a loan, and you need to set some capital aside for it in case loans default, and that's enhance financial stability. And that's the first reason why capital requirements are there. Now, if we want to introduce a green supporting factor or a brown penalizing factor, then that would have an impact on this goal of maintaining financial stability. Just for you to explain, if we take the hypothesis that requirements today are at the optimal level to ensure financial stability, then we can look at what would be the impact of a green supporting factor or a brown penalizing factor. You need to know that today capital requirements are based on historical data about default of loans, about the risk of loans, and let's assume that they are at the right level, that it's the best level to protect financial stability. Now, if we introduce a green supporting factor, we would reduce capital requirements. So in a sense, we would weaken financial stability. This is only possible if the green loans have lower risk than today. So if green loans in the future have a lower risk than what we have observed in the past, then we could reduce capital requirement. Otherwise, we would, since we are at the optimal level now, by reducing the capital, then we would go against the goal of financial stability. And I think this is doubtful. The fact that green have a lower probability of default, it has not been yet fully acknowledged by empirical studies. And I think it's, I don't see a good reason why investing in green would be safer than investing in what we invested so far. So for me, there is doubt about having a lower probability of default for green loan. For the brown penalizing factor, on the opposite, we have a strong evidence that climate risks are not usually taken into account by a financial market now. So in a sense, there is a source of risk missing in the way capital requirements are computed, and also in a way financial market account risk for. So for me, it's much more likely that we are missing a risk now than that we are missing lower risk in the future. So this speaks for me for the introduction of a penalizing factor rather than a green supporting factor. Now, one conclusion of the study is to focus on high climate risk exposure. So the conclusion is to say we need to have a high penalizing factor, but a narrow penalizing factor, a high penalizing factor to have an impact on loans, but a narrow penalizing factor to avoid a credit crunch. So I totally endorse this recommendation. I think it fits well in what we know about climate risk. We did a study here at CEP looking at the risk assessment available on the market currently. And what we did was to ask different climate risk providers to assess different firms. And what we see is that there is a lot of heterogeneity between the risk providers. So two different risk metrics provider can give very different assessment of risk for the same firm. So this is not really a surprise because it's still, assessing climate risk is still a field that is in development. But what we have seen is that, risk metrics providers tend to agree much more on which firm are the most exposed. So in a sense, so they tend to agree on spotting which firm is really exposed to climate risk. They then disagree which one is the less exposed or the one which has the most opportunity, but the one that are highly risky, they tend to agree. So that would be, that would go in the direction of what Julie was presenting. In a sense, we know where are the high risk, so we can put higher risk weight there. And this is relatively narrow in the sense we know only the very high risk. A proposition that is on the let's say on the market now is a proposition by Finance Watch, which I find very interesting. It fits the recommendation of I4CE's paper. They propose to have a one-on-one capital charge for new fossil fuel reserves. So basically, a bank that is lending to new fossil fuel project has to have completely backed by capital by the same amount of capital. Again, this goes in the direction of I4CE recommendation, having a high capital requirement on a narrowly defined here only on new fossil fuel reserves. Concretely, this would mean having a capital requirement of 1,250% on the new fossil fuel reserves, and this corresponds to having these loans fully backed by capital. This is something that you could also look at with your model, I think. Finally, alternative to green supporting factors, we think using capital requirement is the right way to go. Now, you can go either at the Basel I level, as Julie mentioned it, or you can also see looking at capital requirement for the financial system more broadly. So we just published also a policy proposal for that. So the idea here is to say that climate risk is a risk for the financial system as a whole, and this is backed up by research by the ECB, which clearly show that not having a transition is the most risky scenario for the financial system. And since it's a systemic risk, you, following Basel rules, could implement a systemic risk buffer at the financial level, financial system level. This would translate actually almost 1-for-1 in what you study, Julie. It's also an increase in capital requirement, and this increase will be higher for the banks that are lending to polluting and harmful activities. But the reasoning behind that is not to protect the bank, but to protect the full financial system. So I encourage you to also read this piece. That was my comments. Thank you very much.
Thank you very much to both of you. We already have some questions in the chat, so I will raise it. The first one is, and please do not hesitate to ask other questions if you want. The first one is, can you specify the broad scope of the penalizing factor? What do you mean by taxonomy harmful? Does that mean not meeting the taxonomic criteria?
Yes, so to answer the question and to come back on how we choose the perimeter, as you may know, it's very hard to know. So we did it for the French banking sector, but it's very hard to get precise estimation on what share of coal activity bank own in their portfolio, or what part of fossil fuel activity are concerned. So we always worked with perimeter that were similar to the various estimation that we found. And for the harmful activity taxonomy, we took the figure of 10%, which can be seen a bit as arbitrary, because of course it's not based on a very, very strong and deep estimation of what it would be. But our idea was to include not only fossil fuel producers, but also other activities such as the car industry, the aeronautics, so the many others activities that can be considered as exposed to stronger climate risk. So that's the way we work. But on the first one, on the first perimeter, which is coal, here we got some figures that we can be a bit confident about, because it's based on the ACPR figures. For the second one, the one on fossil fuel, here the figures are more are a bit based on the ACPR one, but also on some NGOs. And finally, for the last one, we really depend on NGOs figures. So the idea was rather to work with some order of magnitude, instead of saying it's the precise estimation, but rather to say, okay, what would be the impacts with a very small perimeter, with a larger one, and finally with a much more large one. So that's how we built it.
Thank you, Julie. Another question from Imed Walou. Your study is about regulated entities. What about not regulated entities that can fund fossil fuel sector?
Yes, that's a good question, and that's a question we answer in the report. You can find it. I think it's on the end of the report. What would happen if there was some much more alternative financing solutions that happen, and it's here again. It's hard to have a clear answer, because we have seen that some especially some hedge funds have started to play a part that is a bit bigger, and of course they are much less regulated than banks. But still, what we found is that those kind of concerns are mostly raised by banks in order to avoid some penalization. So what we think to see is that especially for all the general purpose financing, it won't be some hedge funds who will take them back. So it will only be for project financing. And here again, of course, the hedge funds are less regulated, but they are more dedicated to short-term financing and not long-term. So we think that within all the companies financing, if you take general purpose and long-term project financing, it will still be fine. It should still be financed by banks and by regulated entities. But that's a concern. You can find more an answer that is a bit more longer than this one in the report.
Another one, it's two questions actually. Isn't a sector technology specific credit crunch what is somehow targeted by a broad penalizing factor, for instance, fossil fuel sector? And the second part of the question is, indeed, it would be a pity to penalize companies that are really transitioning. How could this be characterized to avoid impacting the wrong companies?
So thank you for this question. So what we found is that when you start putting a penalizing factor, especially if the perimeter is quite wide, of course you're penalizing the sectors that you are targeting, and it's good and it's what you are looking for. But you also have an impact on all the credits, because the banks should hold more reserve for their entire activities, and that's an element that this study brings, is that the credit crunch affects, of course, the targeted sectors, but also the other credits, what we call the general credits, and also affect the green credits. And that's why we say that there is this counter-effective effect. And so that's the element for the first question. Pierre, I don't know if you want to say what now or if it was for after.
For me, I would that's for the second part of the question.
Okay.
I will answer first.
Okay, so I'll give my answer for the second question, and then I'll let you answer. So how to target the companies that are actually transitioning? For us, that's why the penalizing factor is not a good tool for the other companies that can actually transition. And that's why we rather call for Pillar 2 and for a transition plan for banks. We think it could be a mechanism that has a more, I would say, qualitative analysis, and in which you banks and supervisors should be more able to see the difference in terms of companies from the same sector, but to distinguish the one that are doing the right investment from the one that are not. And we feel that with a Pillar 1 tool, you can't have this kind of difference. Pierre?
Yeah, just to complement on that, I think the question raised by Hugues is really key. And it's a concern for central banks and regulators. They really would like to kind of, distinguish between the firms that are transitioning or not. And this cannot be at the sector level. We know now that within a sector, you have some firms that are really trying to transition, and others that are not having the right plans. So what I think here, and I would a bit disagree with you, I think we can still use capital requirement and the risk approach and Pillar 1, just by measuring the risk rightly. So firms that are, and usually what a risk provider to do that is to have forward-looking metrics. So kind of metric that take some information about what are the plans of the firm. So they look at, for example, what is the investment that is planned? Is this investment aligned with the transition or not? You have also other indicators like, do the firm have some commitments in terms of reducing CO2 emission, for example? And by using such information, you can kind of distinguish between the firms that are on the way to the transition and those that are not on the way to the transition. And basically, if you're on the way to the transition, you have less transition risk. You're less exposed to transition risk because you're on the right way. Whereas if you're not If you're not transitioning, then you are very exposed to transition risk. So by using risk here, and especially transition risk, you can still capture which firm is, let's say, good and which firm is bad.
Okay. Another one. Do you think that the results of your study could also apply to the insurance sector, where the debate on green supporting factor or penalizing factor is similar? Would you consider doing such a study but on insurance, or no existing studies that focus on the insurance sector and the Solvency II framework?
That's a question I've been already asked by some insurance supervisors, and my question is, I'm very sorry, but we don't. I mean, we haven't done it on the insurance sector, mostly because I'm much less familiar with it and with how it works. But the good news is that the model that we use are completely public, so you can put your own figures and use these models. It's quite easy to use, I find. So you can do it on your way if you want, but no, sadly, we don't plan to do it on the insurance sector, but mostly because we want to start working on Pillar 2 for banks now. So that's why.
So Julie, you started to elaborate on the Pillar 2. Could you maybe more explore the several options of the Pillar 2 that are possible for supervisors?
Yes, thank you, Pauline. So when we talk about Pillar 2, we are usually mostly thinking about stress test, and that's a path that a supervisor have taken, and some stress tests, some climate stress tests have already start to be done. But what we want to explore is rather how we can look also at the SREP mechanism, so the surveillance process, and how we can integrate some climate element in it. And so we will work on how the bank should include some climate criteria within their own process, and how the supervisor can check on this, and also on what should a good transition plan for a bank look like, and how the supervisor can also look at this. And finally, there is also the net zero commitments, because the banks are listed companies. So when they start claiming that they are, and that there will be net zero in 2050, of course, it's an element, an important element they are putting in the market. And here it's more for the market regulators. And I saw that the AMF expert commission released its recommendation on what should be a good net zero strategy, a good net zero commitment. But I think it's also something we'll look at. So that's what we mean by Pillar 2. And Pierre, if you want to
just to come back on the stress test. So indeed, a lot of financial supervisors now are doing some stress tests for the financial sectors. The ECB did, I think, one of the most comprehensive one very recently. That being said, a stress test just to assess and measure the risk. It's not equal to a policy decision. I think if a stress test is useful only if it is accompanied by change in capital requirement. If we find that there is risk, then capital requirement should be changed accordingly. So stress test per se is not something that will change things. It just give you a better picture. And the picture that is given now is where supervisor kind of agree is that climate risk are risk for at the system level. And for me, the right, if you have a systemic risk, the right tool to address systemic risk is what I suggested in my comments, is to use a systemic risk buffer. In Europe, the framework to introduce such buffer is already there, so financial supervisors don't have to invent something new. They can work with the framework they have now. And one also key challenge when we talk about changing capital regulation is the calibration. So how much do you change it for each bank? And there, I think supervisors are closer to have good calibration at the system level. So they usually have top-down approach, which allow them to assess what is the risk in the system, but which are less adequate to measure what is the risk in each individual institution. So in that sense, they would already have the tools to calibrate a systemic buffer much more quickly, I think, than to change capital regulation at the firm level. That being said, they should do it because currently it is pretty clear for me that the current capital requirements do not include any estimation of climate risk, and there is a risk missing there, so there is capital missing for sure.
And so are this option of supporting factor and penalizing factor are currently considered by regulators at European level?
Who wants to go first?
So I don't know precisely. So what I know is that a green supporting factor is obviously supported by the banking sector. I think the banking sector has an interest in reducing capital and using any narrative, any good argument they find for that. As I said, I'm a former financial supervisor, and for me, I would not decrease capital requirement now. I think the evidence go rather for missing risk in terms of climate risk, and that speaks in favor of a brown penalizing factor. And all the supervisors I spoke to, but I didn't spoke with them very recently, are rather doubtful about the usefulness of a green supporting factor for financial stability reason, and rather in favor of a brown penalizing factor. But there is some support from the bank, and I guess they are good at lobbying also a politician for that. So there is also some support from some politician. I don't know if you have more information on that.
No, what I can just add is that we were, I mean, among the researchers community, we were a bit surprised when in 2018 the Commissioner Dombrovskis announced his support for supporting a green supporting factor. But now in the renewed strategy, first in the action plan, this announced was a bit reduced to rather give mandate to study the opportunity, and then we saw that in the renewed strategy from the Commission, the narrative was rather how we can integrate ESG risk, so that gives a more, I would say, a more balanced approach. But we'll see what really come up from that. But I think politically, it seems at least we saw how hard it was for the Commission to come up with a sustainable activity taxonomy. So I think before we see a harmful activity taxonomy, it will already take a lot of debate. But I hope that the Commission will act at least on the call and all the activities that we can start penalizing quite quickly without having to wait for something for more political acceptance, I would say.
Okay, maybe a technical questions. You apply the penalizing factor to both inflows and stocks. Why not apply them only to flows to avoid the effects of credit contraction?
Yes, so that's also a comment that came back a lot. when we send the study for reviewing. That was one of the points from Pierre also. And here I'd like to come back on what we said before. The idea with the penalizing factor is having an impact. And in order to have an impact, you have to apply both to stocks and to inflows. Otherwise, the impact would happen in a very medium to long term if you start applying only to inflows. So for penalizing call activities, for instance, of course, many banks will not accept new call credits or stuff like that, but you have to target the one they already have in portfolios. So that's why we apply to both stock and inflows.
Okay, I have no more question in the chat. I don't know if someone would like to raise something, but thank you for your very clear explanation and for the studies that contribute to the debate with real figures. That's very useful. Well, I don't see a new question. I don't know if you want to add some comments or provide feedback on comments you usually receive on the study. Or is that
no,
okay?
I think maybe again a technical point. As I think some of you had some problems with well, first me with the slide, but I think some maybe with Pierre's slide also. Maybe we can send them afterwards.
Of course, we will share the slides.
Okay, yeah.
With all the participants.
Well, no, that was a pleasure for me to be here and discuss with you the result of this study.
Well, thank you very much, Pierre and Julie. Thank you very much to all the attendants, and we hope this your study will be used at Goodition by the regulators. Thank you very much. Have a nice day.
Thank you.
Thank you. Goodbye.
Bye-bye.
Bye.